The first thing I like to discuss is that the role of technology and the economics of industries, whether it is telecoms, banking, fintech, or what have you, the fundamental role of especially digital technology, particularly digital technology today, which is a different kind of technology that we used to have from the previous analog. The fundamental role of digital technology today, especially even more driven by things like AI, the same trajectory, is that it fundamentally crashes the transactional cost of industries. A simple example, which is obvious. The days of if I have to go to a branch to do a transaction, I have to go by miles, very inconvenient, take a public transport, and I can do everything today on my mobile phone in 1 minute or two. So that's a classic example of how digital technology crashes fundamentally transactional cost of industries. And what that does is that it now unlocks markets that have been excluded, markets that industry traditionally have considered do not exist, especially incumbents who have been in the industry before. And those are the kind of things that we have seen some of the fintechs do, using new technology in terms of digital financial service to go to markets that have been excluded. The POS system today now is so obvious, but 4 or 5 years ago, probably not as obvious, that 70% of the things that could be done in a branch can be done in a small POS today. And that's what the agency banking model have done, rolling out across Nigeria, of course, with the support of the central bank and very progressive regulation from the central bank. And this is more fundamental in a country like ours, where we are not serving there are still a lot of people excluded. Although we say that formal financial inclusion in Nigeria is 64%, but I want to dig further down and speak to the reality of cashless. There's a data from FINA Access to Finance Society data that actually says that 47% of Nigerians do not have a transactional financial account. That is, if you take those who patronize only agents but may not have an account, but who wants to trade, doing cashless, the reality that we saw, the paralysis of small business across Nigeria, especially in northern Nigeria, tells us that reality, that to collect payment or to receive payment digitally today, that's at December 2023, 50%, nearly half, 1 out of every 2 Nigerians who are micro SMEs do not have access to a digital financial account. And that tells us how much those are the kind of opportunities that digital can unlock if we do it properly, so that we do not experience the pain of that cashless experiment again in terms of digital access to financial services. So, and it's also more obvious from the FINA Access to Finance data when we see that services, digital technology also has the potential to deepen service within existing markets. Prof was talking about existing markets. You also have about new markets. But even within existing markets that we serve, the potential for technology to deepen access is very strong. So, for example, we have today payment, whereas payment is 52% in terms of access. Things like savings is about 32% or so. Credit is about 6%. Insurance and pensions are in single digit. These are the kind of things that technology can do if it work well with regulation to unlock markets, it will grow markets and also unlock prosperity and access for many more people and impact society in a model of shared prosperity. So the second thing I'd like to talk about is then how regulation and markets interact. From the viewpoint, I'm not a regulator, so if anything I've said here is not correct, just ignore it, see it as I'm speaking only from an outsider's perspective, as someone who has been regulated, but who has a strong, who has worked in the regulated industry, but has a strong social consciousness that the purpose of business is not just about profit, it must be about the shared prosperity model in which society and industry prospers together. So there are 10 things which I've identified in terms of the relation between the role of regulation within markets. Number one is that regulation has to drive and provide incentive for market players for market growth. That we do very well across all our industries. We do that from telecoms to financial service to insurance and so on. and so on. And even though there's still a lot to be done. Number two is that regulation must drive effective competition in the market. In my days at in telecoms, we had something with the NCC did about a research about the extent of significant market power among the telecom players. It was neither here nor there, but the fact that the regulator was concerned whether market players with dominant market power are using their market power unfairly in terms of how effective the market could work, how optimal market will work, is one of the fundamental responsibilities of regulation to market, to ensure that market work for society. Number three is that regulation must also drive innovation within market along with competition. Competition will drive innovation and is very critical between innovation and competition. When there is effective competition, innovation will happen because people are trying to compete with themselves. When there's no effective competition, there will be a stall of market growth. So innovation is critical in terms of driving market growth, social impact, especially in things like financial services, to reach markets that are underserved. Whether we talk about telecoms today or where we have a lot of responsibility in terms of driving more broadband access or financial services where a lot of people do not still have access, that's a major responsibility. Consumer experience is also important. When there's no competition, when there's no innovation, consumer experience will suffer. People will become complacent with what they are doing. And we see that manifest in some of our industries and markets. Number four, in terms of regulatory role within markets, is to drive market access for consumers. I've mentioned this. We have 54% financial inclusion. The access to women is much less. In the north, example, some of our states have just less than 20 or 30% financial inclusion. So there is large exclusion within Nigeria. So regulation has a fundamental role to play in terms of driving access. How do we drive market access more fundamentally? And today, one of the major things that should stay at us in the face in financial services is that we want to do cash transfer to help the poor, given economic reforms that we have today in Nigeria. There's no financial rate today, digital financial rate that can creditably and auditably do genuine cash transfer to a lot of people who are suffering today. If we have a digital financial rail in place, if we fix the problem of access, we should have been able to be transferring 10,000 naira to a certain group of people to ease the pain of economic reforms. And in markets like South Africa, as prosperous as they are, even with a higher per capita income than Nigeria, 30% of South Africans have benefit from conditional cash transfers. And that's what we cannot do today because we do not have the financial rate for it, because there's no market access. And regulation has a critical role to play concerning that. Then number five is that the regulation has a role to play in terms of correcting information asymmetry within markets. I will go back to how technology links all these things, because technology is in the middle of regulation and markets. When you have things like large information asymmetry, markets do not work very well. An example of that is that the creditor, the guy who wants to borrow, who knows he will not pay back, is only one who knows he will not pay back. So unless industry players have information on the borrower, the credit market will not work very well. One of the things to reflect on is that how is the credit market in terms of information? How do we increase access to credit information for many more people, make credit bureau system more inclusive, so that we correct the information asymmetry that is not making the credit market work very well. On the other side of that is that we have a situation today in Nigeria where banks, historically that have banked a lot of people in Nigeria, are holding captive a lot of customers, but they have their deposit, but they're not lending to them. If they have been lending to them historically, access to credit will not be 6%. Regulation has a role to play, leveraging technology to correct those kind of information asymmetry and provide access. Because the banks have the information, they aggregate it to themselves, but the fintechs have no access to those information. Some of the progressive regulation we have seen from CBN in terms of how do we have an open banking system where the consumer can elect to say, let my information be accessible by technology to the fintech, so that if the banks will not lend to me, I can access credit from the banks. But what do we need to do? Those are the kind of things that open banking can do. But open banking itself, we need to reflect why it's not working well. What are the issues? but progressively we are moving in the right direction. So those are some of the things that that regulation can do in terms of driving market access, correcting information asymmetry. Affordability is obvious. When there's better competition, prices will be driven down, especially with things like micro payments. If we want more people to use credits in Nigeria today, we need to drive micro payments. With the way people transfer airtime, should be the way that you're going to transfer 500 naira without thinking of charges. What we see with why businesses like OPay agree with the fintechs, with with free transfer, tells us that pricing affordability is much and in usage, and what can we do in terms of driving more affordability, especially with micro payments to reach many more people who are underserved. Then, of course, the moderation of oligopolistic behavior, what is done very well in terms of open interoperable system, both in telecoms and financial services. Number 8 is I call this moderate the potential for signal capture by dominant players, so that they capture regulation to work for themselves. One of the things which we need to continuously reflect is that when the incumbents are very strong, the fintechs always say the banks are too powerful. The fintechs always say the banks, they are not in the room. They are the most innovative players, but they're not in the room when major decisions are being taken. We have the committee of bank CEOs that have a stronger relationship, for example, regulators, for example. Then there's the powerful association of licensed telecom operators and their role. How do we ensure that while we are working with them, they also do not capture regulation only for themselves? Those are some of the things to reflect on. Then number 9 is consumer protection. Consumers are atomized, they are individualized. They do not have the organized market power of suppliers, of industry players, or the telco players, or the banking players, or the fintech players. Who will protect them? They do not have associations. Unless the regulators step forward to protect them, they will be shortchanged. And we're seeing a lot of that from Consumer Protection Department in the Central Bank, from NCC, with some of the things they are doing, but more perhaps needs to be done to ensure that the consumers are protected. Number 10, of course, from financial services, financial system stability and trustworthy financial system. While technology must grow, it should be done in such a way to ensure the stability of the financial system. And we in the industry, sometimes we do not see what the regulators see. Regulators, you see a broader picture than the industry. And you can see, okay, it's good for your business, but it's going to create a problem in the financial system. And that's something very important, so that innovation itself does not just work for a company, but also work in an optimal way for society. In all these 10 issues, technology plays very critical market roles, because you see that whether you talk about information asymmetry, you are talking about platforms. Whether you talk about competition, technology is at the heart of many of these 10 issues that I've described in terms of regulation and market. So when technology is used well and well regulated, it works for business and society in an optimal balance of shared prosperity. When technology is not well regulated, it creates oligopolies, it creates entry barriers, it creates low market access, it creates closed platforms, poor customer experience with no consequence for industry players. And we see some of the manifestations of that in some occasions in our industries. And I want to say that the fact that business is fine or doing well does not necessarily mean society is fine. It's important that regulation works for an optimal balance of business interests and society interests. The third group of things that I'd like to talk about is technology industry boundaries and regulation. The technology industry boundaries and regulation. Today, technology has broken down the boundaries of financial and telecommunication industries and media industries. Financial service industry, telecoms, and media. There's a lot of overlap and in between those 3 industries. There's now a broad definition of specific industry players. An example I will give, I know that NCC and media people are here. To say, for example, YouTube as a business from Google, is it a telecom business or is it a media business? And who should regulate it? That's an example of industry, a new industry leveraging technology that is now sitting in the middle of both telecoms and media. If we are not careful, the media industry regulator for media will not see it. Will be regulating television and only DSTV, but may not regulate what is going on, well effective on YouTube. And the telecom people may be thinking that, okay, this maybe is a media business. it creates a lot of arbitrary opportunities that may work well for industry, but it's important. I think the lesson there is the need for coordinated and cross-industry collaboration and coordination to regulate a lot of businesses today that are the interface and boundaries of previous traditional industry. An example of that are the kind of things we see in terms of pricing for access of financial services, bank transfer charges, USSD pricing, and data pricing. If we do not have the right cooperation between the telecom and financial service regulator, and everyone is trying to work within their space, and maybe even sometimes just protecting their own industry and industry players, we may end up with a situation where the poor may not be able to do a USSD transfer, because by the time you pay 10 naira for bank transfer, you pay I think it's 7 naira for session charge for USSD. Many of them cannot even afford data services because only 20% of people who are on the telecom platform or thereabout are using internet services. And yet a lot of the fintechs who are coming to the market are rolling out apps which need smartphones and internet. So essentially, what that is telling us, unless there's a cooperation, a synergistic cooperation in society interest, not necessarily in terms of protecting their industry, for financial services and technology, we may not have that optimal. We need that critical optimal cooperation between industry, because the first digital rail is the telecom rail. The financial rail is built on the telecom rail, and financial inclusion objective cannot be achieved without that effective collaboration between the telecoms and financial services regulator. Number three that I would like to speak about is what I call public goods and digital public infrastructure and the role of regulation. Just in quick summary, we know it's glad now that everybody's talking about India. The Indian stack story is now very much more prominent in our conversation in Nigeria about the financial system. But essentially, the Indian stack story is how the national digital identity system and national payment system work together as a technology stack, sitting on top of themselves in a way in which anyone that has a digital identity in India automatically will have a financial account, because they were coordinated as a digital public infrastructure, as a national technology stack. Unfortunately, what we have had, due to our dependence and the evolution of our industries in Nigeria, is that our universal payment platform, which is NIPS, and our national payment platform, which is NIMC, they have been historically sitting in silos. And today, the consequence is what I call the 40 million Nigerian missed financial account opportunities. Today, we now have 107 million Nigerians with national identity, according to National Identity Management Commission. Maybe even you back out maybe 1 or 2 children. So we have at least 1.5 million Nigerians. But number of people with financial accounts today is just about maybe best 65 million. That is a potential 30-40 million people. If we have had a historical coordination of identity system and payment system as a national public stack, we will not have had this missed opportunity, which is huge. And so that's an example. And regulation has a role to play in terms of directing the infrastructure players, whether in public sector or in case of even NIPS that is owned by a quasi-public-private sector relationship, to work together to drive that digital public infrastructure coordination to provide public good. Sometimes industries are fine with what they are, but what we are missing in terms of impact is huge, and that's the role of a DPI system. Regulation has to think in terms of how our national public infrastructures are going to work together in complements to drive more public good for society. For example, for our regulators, how can NIMC and CBN work together to say in the next 2 years, let us find those people, those 40 million Nigerians who have digital identity already, but they don't have financial account. We know where they are, the data is available. How can we find them in the next 2 years so that we bring those 35 million people into the financial system very quickly? It is possible. But if the regulators are sitting in silo or they're not working together, everybody is fine. CBN is fine, NIMC is fine, but we may miss that 40 million opportunity that could happen because of regulatory and infrastructure coordination between payments and identity. The last group of stuff I'd like to just share is what I describe as financial inclusion goals, technology and interdepartmental cooperation. Just even looking at the financial system, speaking from my experience. Financial inclusion is an institutional goal, for example, for a financial system regulator, but it's not necessarily a specific departmental goal. Hence, some of the financial inclusion goals that we have, because they are not specific to departments within, for example, the CBN, they can fall through the cracks. For example, if reflective as an outsider, sometimes you may wonder who's exactly access to credit in Nigeria. Who may wonder who's essentially responsible for driving access to credit in Nigeria. There are several departments. There is, for example, banking supervision. There is OFID. There is risk department. But these departments drive different aspects, and they have been traditionally organized in the old banking way. Now, access to credit in the last 13 years have only moved from 2% to 6%. 13 years we only according to FINA data, 4% growth. And it's always not clear who's responsible in terms of delivering this. Different parts of the institutions are doing different things. But technology is changing the traditional lens and structure of defining responsibility, even within regulation. For example, one of the things in terms of reflection will be, for example, you have the Payment Service Management Department, the PSMD. PSMD is responsible for driving payments, and they've driven a lot of very successful. But the PSMD is not responsible for credit. Credit access is not the goal of PSMD. The goal is driving payment access and trustworthy financial system. But meanwhile, one of the things we've learned in the last 4 or 5 years about financial inclusion is that today, only just 9% of Nigerians are served exclusively by banks. More people today are served by a mix of fintech agents and banks. People who are served only by banks, according to FINA data, December 2023, are just 9%. What that means is that if we must solve the access to credit problem, we have to leverage the payment rail to solve it, because more people are transacting with the payment rail today in technology. And so that's what we have seen. Payments have grown in 13 years, between 2010 and 2023, according to FINA data, from 22% to 52%, 2010 to 2023. But access to credit within the same period has only grown from 2% to 6%. Meanwhile, the MSME, the trader on the street, is not necessarily a registered business. They are trading in their personal name as consumers. They have accounts and so on. If we must have access to credit, one of the things that we may need to have is how we will need to leverage the payment rate to have access to credit, and how different departments will need to cooperate in a flexible regulatory system to ensure that goals like access to credit is not falling through the crack. Microfinance banks are great, but the microfinance bank as a classic model, may not necessarily be the solution in terms of scaling access to credit. More people will have access to credit if they can do it right on their phone through their payment platform. So how do we ensure that whoever is responsible for credit also works directly, closely with the payment regulators, who may not necessarily be given credit license, to ensure that we leverage payment rate to access credit? So that's an example of how technology is changing the traditional structure of even how we need to rethink how we are organized in terms of overall financial inclusion goal. So in conclusion, regulatory oversight of technology is critical to ensure market growth, access, inclusion, affordability of the financial system. It is critical that regulators work together while focusing on growth to ensure maximum returns in terms of social impact. A key question that must always be asked is that is industry and technology working optimally for society? Coordination among regulators, even within departments, within regulatory institutions, is very critical as industry boundaries are broken down today by technology. Thank you very much, ladies and gentlemen, for listening. Thank you.